Sorry, no, I'm watching at small slides with the description, not the big slides.
Oh, okay. Let me switch. Try that. Is that the same or better?
It's the same.
Oops. uh, well, I'm not sure how to fix it. Um,
If that's okay, just leave it like that.
yeah, I'll just work with it. So here's where we are with cotton prices as of a little earlier this morning. Um, what I want to highlight to you is sort of a little bit of explanation for the roller coaster ride that we've been on this year. So back in about May, we saw cotton futures prices reach their peak, and I would point out that the build up to this peak was like a year in the making. It started below 50 cents, so this climb is a pretty astounding rally. Got up over $1 on speculative buying and fears of a short crop and other stuff, and it gone on up and it peaked up here, and then we had this plunge from basically in the month of June. We saw that, and that's pretty astounding too. That's a 50-cent decline in 6 weeks. And it was attributed mainly to fears of a recession, fears of what the Federal Reserve was putting the brakes on the economy, and if the economy slows, then people buy fewer apparel items, discretionary clothing purchases would be lower. So it's fears of weak demand gave us this. And it's astounding that this happened, because this is right in the growing season, and it's in a terrible growing season. Drought and bad weather over in the southeastern U.S. and drought in the southern plains that we're all familiar with. So the fact that this could happen at all in the growing season, when we didn't even know how much or how little we'd actually be harvesting, is pretty astounding to me. Well, anyway, you get down to here, and then we had the release of the August supply and demand report by USDA, and in that report, USDA came out and they cut 3 million bales off of the U.S. Production estimate. Now, the fact that they cut the estimate is not a surprise. Again, we're in a drought, but cutting 3 million bales in one monthly adjustment was pretty bold of them, and the market's reaction was this. It shifted back the focus back to the supply side, and got all revved up about how little cotton production there was going to be, and so it gave us this rally here, back up over $1, back up over it got to about $1.16, and it churned up there for a little bit, and then it plunged again. This plunge was 50 cents. This plunge has been 40 cents. To have two of those in the same year is pretty amazing. I mean, this is incredible levels of market volatility, but there it is. Again, the reason given for this plunge is basically fears from the demand side. Again, fears of weakening demand. Fears that the economy is going to tank and that people are going to lose their jobs, or people just aren't going to be spending money on apparel. That's the reason that's been attributed here. And so here we are now, way down at these low levels. That's the harvest time December 22 futures price as of an hour ago, and it's down there close to next season's harvest time futures price. So we're back in the realm of low prices. Like I say, I've tried to explain it in terms of changing expectations about about weak demand and then short supply and then weak demand again. You don't really see it. These are the latest numbers from USDA that came out in October. They didn't really show all that much. They didn't tinker with the production side of this at all, or barely. They changed yield about a pound. It didn't really affect the estimate of production. And so I'll say that to make a point, and that's basically as time goes by going forward from here, there's less and less room for surprises about what the production is going to be, because it's, we've harvested South Texas, and North Central Texas is probably beginning to be harvested, and the High Plains will begin to be harvested, and then we'll know. It is a short crop. It's a small crop. It was impacted by the drought, but the uncertainty of it is fading. And as the uncertainty fades, there's going to be less room for surprises like this one. So I think where we are now with these low prices, I think we're going to be trading probably range bound. I don't think we can go too much lower than where we are, but I don't think there's in the cards. I don't think there's room for this kind of surprise to give us that kind of rally, at least in the old crop, in the blue line here. I think we're kind of stuck down here in the upper 70s and 80s probably, and we'll bounce around at a low level. That's just my feeling. We'll see. Because I think the production side of this balance sheet is getting settled. They'll tinker with that number some. They may cut 500,000 bales off of it, but as time goes forward, there's less and less room for adjustments there. The big change that did happen in the October supply and demand numbers was not in the U.S. balance sheet. It was on the world demand. They didn't tinker with U.S. domestic use. That's here. That's the 2.3 million bales that we spend over in the Carolinas and Georgia and places like that. But they cut 3 million bales off of the world spending number. And again, that's a reflection of slowing economies and slowing demand. And that's probably reinforcing the downward push in prices right now. Let's look at some other influences. This is more evidence. This chart, which has a lot on it, is more evidence to me of weakening demand. So what this chart shows is weekly net sales of U.S. cottons, like 350,000 bales there and 475,000 bales there and 500 and something thousand bales there, up and down weekly. What I want to show you is over here and the red line is price. What we expect to see is that when prices get really low, like here, when prices get really low, like here, we have big spikes in sales. When our cotton is cheap, people buy a lot of it. That's what's supposed to happen. Well, look over here. We've had a huge drop in price, and we had a bit of a response, but I would have expected sales of 500,000 bales given this drop in price, and we didn't really see that. We saw that was the highest that we got, 250,000 bales of sales following that drop in price. And now we've had another drop in price, and we're not selling very much, hardly at all. That tells me that there's an inward shift in demand, that this demand weakness, this is evidence of this demand weakness. And that's probably one reason why prices are going down. Another reason prices are going down is because all the speculative buying that was in the market before, all the speculators who were making bets that we'd have such a small crop and they were bidding the price higher. I'm going to show you the decline in speculative buying is this green area that's going down, 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 and prices are going down with it. What that is speculators who were long, they were betting for higher prices, they're selling out. And that's been happening over the last couple of weeks. They're selling out. That went down to there. Here's August. We had that bullish supply and demand report. They cut 3 million bales. Well, they got back in the market. They took the price up to only to there, and now they're backing off, and the price is going down. So the speculative support is fading. So, like I say, what I expect to see with the current crop market is we'll probably bouncing around at a lower level, somewhere in the 80-cent range. I think this is past us. The opportunity for selling over $1 is probably past us for the old crop situation. Now, the new crop deal is a little different because of a couple things. Number one, this drought that we're in, this La Nina condition, is forecasted to continue through the winter and into the first quarter of next year. And if that's the case, then we got dryness on top of dryness. I hope the rains that you're getting, Pancho, right now, provide some benefit, but the fact is it's relatively dry now and it's forecast to be relatively dry going forward, at least into the first part of next year, which means that, you know, we could have high abandonment. We could have a lot of insurance claims next year. My guess is that because cotton prices are so low, especially new crop prices are so low, and they're low relative to wheat and they're low relative to corn, which means they're low relative to sorghum. I think we're going to see a cut in planted acres next year. And so what I'm thinking is if we have dryness on top of a low level of plantings, we may not, you know, we may have really low production next year. And so sometime in about April, there could be a rally, you know, when the market realizes, man, we only planted 9 million acres and it's still dry, so we may abandon 30% of that. That's not very much cotton production. So the market may have a strong reaction, you know, once everything gets planted and it sees the level of plantings and it sees how dry it is. There may be a price rally next year that might take us back into the 90s, back towards $1 in the new crop market. So we'll have to see, but we'll also have to see how it's trading off, how that effect trades off with this shrinking demand situation that we're in. I'll skip that. And here's my contact info. I'm going to have to get off and get on another call before this is over. But if anybody has any questions, feel free to email me. Email me here. If you want these slides, I'm happy to send them to you. Just send me an email here, and I'll get your questions answered or get what you need. So, thank you, Pancho. With that, I'll try to
Thank you, John.
get
Thank you very
out
much.
of here.
Excellent. Do you have any questions for John? Not, then you can email that. Let me share my slides now. Can you all see those slides? I guess that's a yes.
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 Well,
Morning.
so basically, what we have this year, and we still having from last year, we're expecting to have in 2023 are the same, mostly, you know, big issues: Russia, Ukraine, global economy are going to be affecting, you know, exports, and also what we are still going to have and see high input prices, you know, and drought, and of course, you know, good prices, and for other crops that you know might affect, you know, how much acreage is going to be planted next year. Now, this is other some, you know, don't start talking about recession, you know, how it affect cotton, and I think that we need to start considering that also as a possibility. Drought and all the problems that we have, all the conflict with Russia, Ukraine has created all these, you know, high premiums, almost commodity prices and high prices. But this is, you know, on green, this is net farm income, okay? And we have seen that lately, you know, the net farm income, even with high input prices, it has increased, okay? Now, the shaded areas, that's when we had a recession in the US. Most of the times when we had a recession, that did not help, okay, net farm income, mostly in the US. The only time that was the other way, it was during COVID time. But most of the times, and I think here in 2008, and basically that was because it was a supply problem. We had high prices of commodities. What was going basically South America, but we need to think that there's one of the risks that we may have is coming into a recession. Okay, now let's look at prices. I don't know if you remember, by July 2020, okay, this was what, 2 years and a half ago. We have prices that were about 386, you know, on wheat, 340, corn 295, sorghum. Those were, you know, they was not that far away, okay. And those prices, things start going up first because we have about 3 consecutive lineas, okay. We start with that with you know, drought that affect Brazil corn, and that those corn prices start in every start going up and everything start following corn. Um, then wheat start having their own life. But it was about February 2022 that we see prices going really high. Basically, that was when Russia invaded Ukraine. We had this huge, premiums on prices because of the uncertainty of what happened on the market, what gonna be Ukraine was going to be able to export anything. Now, about July, those prices went back to the levels before the Russia invaded Ukraine, and now they start going up again, and that's mostly because drought and uncertainty on given all this the conflict that is keep going up with Russia and Ukraine. During the winter time, how much is going to be able to export. Okay. So when we look about corn, about 62% of corn is in a drought area, and this was, has increased. This is not really intensive, but it has increased, these last months. So when yield, every other, this is May, this was the what was the expects, and they have decreased in acres and yield almost every month. So they have been action. Okay, when we look at crop conditions on black, this is 2020. We can compare these crop conditions to 2011. Okay, and just to have an idea, in 2011, production was about 6% below the trend. And now we are about 4% below the, okay, on bushels on 2011 was 147, and bushels 2020 was 178. We are expecting, USDA is expecting about 17.9, that's 4% less. And remember that we have new genetics, agronomic practices, and that's why we have higher strength every year. Okay, so U.S. corn production on this last WASDE is mostly those beginning stocks decrease, okay, and they decrease exports. So that shows a slight decrease ending stock. Now, when we look worldwide, all days of use, okay, days of use on hand, we can see that around the world, these last 3 years, corn production has been, steady, is lower, is tight. Those ending stocks are tight. How much we have is tight. When we look at China, they have been, these last 3 years is still tight, and US has gone down. So ending stocks are going, and ending stocks are being tight, and that's what is keeping prices and these nervous. Now, a few things about sorghum too. We were trading this last year with big premium sorghums over corn, and usually that is, associated when we have exports, big high exports of sorghum. Sorghum, most of the sorghum we send it to China, we export that to China. China, first, we are going to produce less. Second, China is buying much less sorghum, not just here in the US, around the world. And that create, when we don't have so much export, that has created, those premiums disappear. And now, sorghum is trading on a discount or on for the last 3-4. When we look at sorghum supply and demand, okay, we finished ending stocks 2022-23 are expected to be about, half of what it was before, million bushels. Now, even, going back to normal planting and with, normal yields next year in 2024, those production, that ending stocks are gonna be might be a little better, but they're still, gonna be tight. Look at wheat, okay, last WASDE, it decreased production a lot. It decreased planted acres. It decreased harvested acres. and it decreased yield, expected yield for, okay, which finished, with lower ending stocks from supply and demand. We had probably 2023 ending stocks are gonna be the lower in the last 10 years. I don't have the chart here that far. But what is interesting is we have, about carry over 30% ending stocks about 576 bushels. Next year, plant more acres given these high prices. If we harvest normal, with a normal abandonment rate, if our yields are close to the trend for 9 million, 10 bushels per acre, our ending stocks gonna be higher. They're gonna be higher, but still not as high as they were in 1920, 18, 19, 17, 18. Those where we have, 3.5, on, okay. Now, look at world production. Wheat world production has decreased a little bit, but still, it's still very high. Most of that, on EU, Europe is going to produce a little less. Ukraine was is going to produce less. Argentina was, last was a little less, and all that is compensated mostly by Russia and Canada. Okay, but there are still some risks when we talk about all this Nina, how it's affecting is, other than, Ukraine war affecting southern hemisphere is being, not Australia. Australia is having, but it's going to drop. But, Argentina and Brazil are going to be affected, by the drought. Okay, so world wheat on days of use on hand, the U.S., they have dropped almost every year since 2017, 18, and the stocks are going down. And I was, it was, and, days of hands on use was probably 13, 14. That was, the last time we see them this low. Now, when we look at world less China, they are still going down, and even on those days of use on hand, they are going down. Okay, that's what these high prices that we have seen lately. When we look at, days of use on hand, okay, here, and we compare with what would be the price depending on how much days of use on hand on this model. We model about for 2020, 2022, the model says about $860 price. USDA price for this 20 year is about 920. And if we look, how much the model will forecast, it will still forecast, high prices on the range of about $9, on the range about $9 given the, okay. And if we look at what future prices look at in Chicago, look now in July, I think it's about 940. Markets, they are still forecasting really high pricing. Okay, now most of the prices that we see, and with this is my last slide, or the next final slide, sorry. So drought and the conflicts are, and Russia conflict is mostly are big reasons why we are having now these high prices. And with these tight ending stocks and how we are, the weather is going to be in the future, we market don't see those. It's going to be really hard for the market to send these stocks and go back to, high levels again, at least now in the very short term. Okay. One more thing is when now October 18, this is how much winter wheat area is in a drought right now. About 70% of areas in a drought. Now, I was looking at this thing, trying to see when was the last time that happened, and I think I have to go back to 2012, and it was 65%. Okay, so even though we say that, we have plant acres and we have a good yield, the scenario, how are we going to start planting the wheat? Wheat this year is tougher than any other scenario that we see as 10 years. Okay. And at last, talking about Nina drought, this is what mostly has been playing, because been playing hard on the market, the biggest variable, and we still have anemia until January, February, March. Okay, 50% higher to have anemia, which is correlated with drought. Now, so and we see these models and we look at how they look back to neutral in the end. Remember that these are really good to predict what happens in the very probably 3 months or 6 months, but when they go that much far to go, happens 9 months, they almost all these models, they always tend to show neutral at the end. Okay, so now from the optimistic view, we're still having some rain. Okay, we need to watch out for drought, how it's gonna still affect it. We have tight ending stocks and ability of having ending stocks going back to normal levels in them are low, and we watch out for recession and how that is going to. So with that, David, I will let you do your presentation.
Hey, thanks, Pancho. See if I can pull this up. What the? Pancho, can you see that okay?
I cannot see the slides. I can see all your.
You see it now?
Yes, now I can see it perfectly.
Okay. Well, you know what? As luck would have it, it asked me to update the drivers for this thing right when I turned this on to try to talk. So I don't know if I was going to get it to work or not. Anyway, thank you, Pancho. Thanks for having me with you. Thanks for being here, everybody. I'll talk a little bit. I'm going to focus on the cattle market this time. I've slid in some slides before on sheep and goats. This time I'm going to stick to cattle and a couple of things that have popped up in the, just lately. Obviously, the cattle on feed report came out Friday, and I want to show 3 or 4 charts from that because I think, there'll be a lot of stuff written about it. We'll see lots of things about it, but I think pictures help a lot. And I want to highlight a couple of things out of this. If we looked at marketings were up like 4% year over year. We've got a lot of cattle on feed. We're also moving a lot of them. If we look at marketings, these are cattle going from feedlots to slaughter. And the last 2 months, certainly much larger than the year before. But it highlights that we're able to process those animals. There's not a backlog. These are large amounts of head going to slaughter, and we're able to handle them, and those are going. So, that in a way, to me, this is pretty encouraging in terms that we have large marketings. We've got a lot of beef being produced. In fact, we're basically looking at record large beef production this year. Last year was the old record. We're going to produce even more of it this year. And so even with large numbers available, large numbers coming out of feedlots, we're able to handle those pretty well, and marketings reflect that. If we looked at placements were actually down 4%. They were a little bigger than I expected them to be. I thought we'd be down about 1%. We were down a little more. I would point out that normally, these August to September placements normally increase. We start getting a lot more calves, heavy calves coming off of ranches all over the country that normally get placed right away. It's a relatively rare thing that placements decline from August to September. But there we are right there on the 5-year average. We're down about 4% from a year ago. So what I should say too is if we broke this out by weights, we had a little bit fewer under 600 pounds placed, or excuse me, under 700 pounds, and even more reduction in the over 700 pounds. So relatively more lighter weight ones were placed, about like we would expect. You know, Pancho's charts, John used charts about drought. When I show a couple of price charts, we'll come back to this idea, but I think we certainly see the effects of drought in our wheat pasture winter grazing really hitting our calf prices, much lower calf prices, especially lightweight calves. Some of that is seasonal. Some of it, I think, is some lack of demand for those calves, just simply because of delayed development in wheat pasture. And so, you know, those placements, you know, we may have placed some ahead a little bit. We've certainly, but sooner or later it has to reflect a smaller cow herd, smaller calf crop, and fewer placements. So that's where we were for placements. I thought that's pretty interesting to note that decline from August. We're typically building, not seeing a month-to-month decline. Here's the weights. I mentioned that cattle placed weighing less than 700 pounds. You know what? I think I forgot to take that one out. We were actually down a little bit this month. That's the old chart. But here's cattle on feed. And we finally dropped, I think, pretty significant to note that we dropped below a year ago. So we're down 1% on cattle on feed versus a year ago. It's something we've been expecting for a while, that as we got later in the year, that, you know, we're going to get fewer and fewer cattle available to be placed. And our marketings at these high rates really indicate that we're pulling cattle on feed down. That's something we ought to see going into next year as well. Fewer cows, fewer calves. Sooner or later, placements catch up to that, even though we've pulled feeder cattle ahead, either due to drought or profitable expectations. And so now we're finally seeing cattle on feed below a year ago. You know, I should point out too, I didn't put a chart in here of fed cattle prices, but we continue to see increasing fed cattle prices, even though we've got marketings and slaughter up 4% over a year ago. Southern Plains were at about 145 for fed cattle prices, and higher than that in the Northern Plains. So starting to see cattle on feed being pulled down below a year ago. In terms of price projections for into next year, I think this is a real positive for prices, you know, tighter supplies and higher prices because of it. If we dug a little deeper in the data, this month's data is when we get the breakout. It's a quarterly set of data, the number of steers versus the number of heifers. You know, we're pushing 40% of the cattle on feed being heifers. Boy, that's the highest going back to 2010, and I didn't go back any further than that to look at it, to really, you know, to dig in any further, but to note that more and more of our on-feed numbers are heifers. You know, we're sending more cows to market. We're culling more cows nationwide. We're not holding back replacement heifers, and it really shows up in the on-feed data. And it also should reflect, too, fewer steers on feed simply because of smaller cow herd and fewer calves born. And if half of them are steers, you know, we've got fewer steers available to be on feed as well. So we see this going really in the direction of continued herd liquidation. Speaking of herd liquidation, I included cow slaughter. We almost hit 80,000 head last week. There's a 2-week lag in that data. So for splitting it out, it was 2 weeks ago. But almost 80,000 head were reaching to the time that we see our normal seasonal peak in terms of beef cow slaughter. I had hoped we might see those back off a little bit, just simply because we slaughtered so many cows earlier this year, but we are headed for our peak. That almost 80,000 head in the last reported week is as big as the biggest week last year, and it's pretty easy to see every week this year we've slaughtered more beef cows than we did last year. So out of a smaller herd, we continue to shrink the herd. So those are pretty big numbers of cows going to market. in terms of prices, we really see this reflected in, and I'm going to show here auction prices, kind of Southern Plains, North Texas, Oklahoma, Kansas. And what I should point out is we have a lot of cows going to market. We certainly have a lot going to slaughter. As we look and dig into some of this slaughter data regionally in the U.S., where we have this big drought in the plains and in Texas, we certainly see some sharply lower cow prices at auction. We get a few more thinner cows that see some very low prices, but it shows up in the auction data in terms of cow prices pretty directly. So, last week, not only were we below the 5-year average, we were below last year as well. So really taking a hit in local auction markets. But if we looked at direct prices, folks who can take cattle directly to the slaughter plant or are in regions not hit as hard by the drought as we are, we actually have prices well above a year ago. Or for cows that are in better shape, they got more on them. They aren't lean, they aren't run down. There's a lot more meat there. Those are seeing much better prices than a year ago. In fact, we look at some local markets outside of kind of the Southern Plains, and we've got prices up 20% year over year. Even though we still have a lot of cows going to market, we still have the demand for those cows and prices are higher. Let me show a couple of calf prices. Boy, this decline in 500 to 600 pound steers, we could show the same thing in 4 to 5s, really from over $2 a pound to under 180. Again, sort of a North Texas into Oklahoma price. I think it really, if we looked at local auctions as well, the same basic trend in prices, much lower prices forced by, I think a couple of things. One is higher feed costs. We've certainly had feed costs go up over this period, but also drought effects on wheat pasture development. And so I think it's really cut the demand for those calves. But I also should point out, too, we seasonally decline in prices this time of year. So some of that is a seasonal decline as well. But all of those factors are working to keep those prices lower than they otherwise would be. Just to stretch yourselves a little bit, I thought I'd include the cutout. What I wanted to point out in terms of wholesale beef prices using the cutout value for choice beef, we've basically been declining slightly in price since mid-year. And we've actually gotten down in terms of the wholesale market, the lowest prices since the first week of April in terms of the choice wholesale box beef cutout. So we've certainly seen some lower prices. We have some cuts starting to take off seasonally like they usually do and moving above a year ago, particularly the stuff like some of the fillets, the ribeyes are increasing a little bit. And seasonally, this is when our chuck prices, you think about a chuck roast and things, it starts to get colder, those pick up in demand, and we're seeing some growth in prices there as well. And so it's a mixed bag within those cuts, but overall, some drifting lower prices in the wholesale market. Which gets me to this. I thought I would point out the choice select spread. So that premium for choice over select has really skyrocketed. We're producing a lot of beef. Even though the choice cutout has declined, we've actually got a little more choice beef on the market. But it's right close to a year ago. We've got a lot more select on the market because fewer are grading choice, a little more grading select. And this spread is really widening. And so while we would see that, if we look at this red line of the 5-year average, we would normally see that increasing here as some relative demands and supplies change. We've really got this moving in an upward direction. That premium for choice over select is growing. And I think if we look back to last year, back in about September, August, and again mid-year, those were about our record highs of all time. And so we're pushing those levels in a choice select spread, thinking about what those premiums are for higher USDA quality grade beef. So there's a whole shot of stuff around about a bunch of things on the cattle side. I think the 3 big takeaways is the cattle on feed report. What I think is important is fewer cattle on feed overall. a lot more heifers on feed. We got a lot of cows going to market still. And I think we certainly see some drought affected prices, particularly on our lightweight calves. Squeezing that spread or that normal slide from heavyweight to lightweight calves is getting narrower, really forced by drought and feed costs. So that's also my last slide. Let's see if I can end this show. Maybe. Pancho, did I get that thing turned off?
Yes, you did.
Cool. You guys got any questions for me?
Great. Hey, you can always email us if you have any questions, you know, if you need any more information. Thank you very much, everyone, for coming. And see you next month.
You guys have a great week.
Thank you.